Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another good week. Market making new highs. I wouldn't get too excited about that, but it is nice. And still the small mid-cap stocks tend to be outperforming, which is good. We'll talk about why that might be at the upcoming seminar, which is soon. And I just noticed on my Microsoft-based laptop, the colors on my website look a lot different. Interesting. Anyway, so we got a workshop coming up March 16th. That's a Thursday, right before St. Patrick's Day. That should be awesome. It's going to be at Corporate College East Side. We're going to be talking about the book Intelligent Investor. It was written in 1949 by a guy by the name of Ben Graham, who, for those of you that don't know, was Warren Buffett's graduate school teacher and first employer outside of his working for his father's brokerage firm. The had a big impact on professional and amateur investors everywhere. It's considered by many to be the father of value investing. And we're going to talk about a lot of the things that he talked about, a lot of the precepts he set forth, and we're going to update them to present day. I think he would agree. I know he would. Just common sense kind of stuff. But we're going to talk about some of those concepts and how that might fit into your retirement portfolio. I think this is a really important time for an awful lot of people. You're getting closer to retirement. You want to make sure that you're doing smart things, because running out of money during retirement, not most people's idea of fun. So we are going to be talking about how you can incorporate the margin of safety concept. That's what we're going to be talking about, which actually goes a little bit against the grain for me, because I've generally been much more aggressive as an investor. And stocks, incidentally, stocks are all volatile. There's no way of getting around the volatility, but you just have to try to manage it. And some of the ideas that Ben Graham put forth, they wouldn't work exactly the way they did in 1949 when he wrote that book. But the basic idea of trying to minimize the risk in your investments is still very valid. You don't have to give up all the return either. When you're managing your risk, it's not about giving up returns. It's about trying to achieve decent returns while minimizing the amount of risk that you're taking. And there are tons of different types of risk, by the way. And I know that confuses an awful lot of people, especially when they first start investing. The vast majority of people think risk is just losing all my money. Well, that's one risk. Another risk is that your money's not growing fast enough to keep up with inflation. That's an inflation risk. Another risk is if you're buying bonds, there's a credit risk. That would be similar to stock market risk, prices dropping. Bond prices tend to drop when a company gets in trouble. Got an interest rate risk. Interest rates go up. Bond prices have a tendency to drop. If you want to see a really good example of that recently, take a look at the TLT. That's long-term treasury. Now think about this. These are all long-term treasuries. Okay, treasury bonds, United States government. The fund that invests in them was selling for $143. I'm going to give you the date. In July of last year, it's at $120 today. Now, those are government-guaranteed bonds that are down almost 20%. And I think they're going to go down a lot further than that. So buying them because they had a slightly higher yield than you could get on CDs, well, how much more return are you going to have to get to make back the 20% you're down by now? It's pretty big. So there are all kinds of risks, and you got to have an idea of how you intend to handle them. How are you going to handle the risk? How are you going to manage the risk that you're taking? That's what we're going to be talking about, especially when you get close to retirement. When you get close to retirement or you're at retirement and you're taking money out of your portfolio, how are you going to manage the risk? Unless you're worth $1 billion, or maybe I guess for a lot of people, $10 million. If you got 1% on $10 million, be $100,000. So if you got $10 million, you can have $100,000 of interest on a 1-year treasury paying roughly 1%. I don't even know if the 1-year treasuries are paying 1% right now. Probably not. But anyway, you can get a CD that's paying 1%. And you need $10 million to generate $100,000. You need to, and a lot of people, well, I only need $20,000. Great. Then you only need $2 million. To do $20,000 in a 1% CD, you need $2 million. Yeah. So if you don't have $2 million and you'd still like to have $20,000 of income, you're probably going to be forced to invest in stocks, bonds, cash, a mixture of assets. A good balanced fund to be able to generate those types of returns. So if you got $1 million, you want to take out $40,000 a year. That's 4%. Okay. You're not going to get it in CDs. So we're going to be taking a look at alternatives, managing the risk. This is value style investing. The concepts that Ben Graham talked about 1949. Warren Buffett's still doing. In fact, there's a big story in the Wall Street Journal today. He's hired a guy to run an insurance company. Most people don't realize how much the insurance operations of Berkshire Hathaway have meant to that company. Vast majority of that company's gains have come from the cash they've generated from the insurance companies that they own completely. You hear about the investments in Coca-Cola and Wells Fargo and all that other stuff. Those are minuscule. The big money comes from insurance operations and always has. In fact, they're more diversified now than they were when they were smaller because they concentrated so much more heavily in the insurance department because very successful business and very profitable business and has afforded all the other investments into an awful lot of other things. So I'm not sure how many people realize that. But back in the 1940s, 1930s, 1950s, 1920s, the people really didn't know a whole lot about analyzing financial statements, trying to minimize the risk. That was the concept, minimizing risk. They also didn't know a lot about the market. And Ben Graham was one of those visionaries who sat back, took a look at what people were doing, analyzed it, and said, okay, here's the behavior that's occurring. That behavior, by the way, is still in existence. That hasn't really changed that much. Stock market hasn't really changed all that much. One of the big changes lately, which we will cover in detail at the workshop, is the invention of market cap weighted indexing. That's not the best way to invest, by the way. I don't care what its long-term track record is. Too much risk, especially if you're retiring. What do I mean by that? Well, the S&P 500 was down 50% twice in one 10-year time period. And had you retired in March of 2000, doing the things that are most popular, that are actually talked about and recommended by a lot of professionals, more so than most other strategies, which is market cap weighted indexing, you would have about half of the amount of money that you had when you started if you were only taking out 5% a year without an increase for inflation, by the way. So let's say you had $500,000 and you retired. If you took out 5% a year, you're down to about $250,000 now. And 16 years later, prices, and you haven't, actually, on the one illustration I did, you did actually increase for inflation. So I'll have to take that back. So if you kept up with a 3% increase for inflation, you only started with 5%, you've got about half the money you started with. And you're really wondering, am I going to run out of money? You're really wondering that. Exactly what you want to do when you're in your mid-80s, right? Wonder about running out of money? It's exactly what we don't want to do. And that's one of the problems I see with the conventional wisdom today. The fact that Vanguard, big story all over the Wall Street Journal. Yes, they've passed $4 trillion in assets. Mutual funds are the biggest mutual fund company. The number one asset gathering device for them, the funds that are gaining the most money new money that's coming in, are all market cap weighted. They're the ones that would have dropped in value so far that had you had bad timing on your retirement, you retired March of 2000, you'd really be worried about running out of cash. You'd really be worried about running out of cash. So we're going to talk about some strategies that actually would have helped, could have helped you not do so poorly. In fact, a couple of them, you'd actually have significantly more money than you would have. Now, that's all. And by the way, I have to tell you, these are hypothetical illustrations. I can give you the names of a couple of my clients that have been with me that long that are still alive, by the way. That's one of the funny things about this business. The people are generally a lot older before they have accumulated a lot of assets. So a lot of my clients are older. But anyway, that's another aside. You're looking at doing some things, anything that you can do to help prevent a 10-year period with no returns. Because if you're spending 5% of the money and you're increasing it with inflation and you go through another 10-year period with no returns, you're going to be wondering whether you're going to live long enough to outlive that money. And it's tough. It's very difficult. So we're going to take a good hard look at that. What kinds of things can you do to do that? Market cap weighting, I'm not a big fan of that. If you were a market cap weighted index and like the S&P 500, even the Russell 1000, I like Russell better than Standard & Poor's, by the way. They're more open about what they do. They don't try to create a lot of mystery, and they actually publish a lot of really good research that's very helpful. And been very helpful to me in my career. They've been a lot more open about what they do, how they do it, than Standard & Poor's. Standard & Poor's is pretty good, but Standard & Poor's is, I'm not sure they would actually pass the fiduciary rules. I know I'll probably get a threatening letter from one of their attorneys now. But hey, this is an opinion. This is an opinion. I look at some of the things that they're doing, and I'll be glad to point them out for you very specifically. You want to call me up? Yeah, so no problem. That's my opinion. And a lot of the tactics that they're using would actually violate some fiduciary standards. It's a good thing they don't manage money. They just sell research. That's basically that's how they get around that, by the way. Anyway, so I want to be positive here today. There are lots of good things. And by the way, they do some good things too. They do a lot of good things. In fact, they've done better than average investors done. They've done better than an awful lot of professionals have if they would have stuck to that. But what I'm asking is that the best? Is that the best thing for you? Is that the best thing for me? Because I'm really interested in being able to retire one day and not having to go back to work in my 80s. That'd be nice. So again, we're going to be talking about that at the workshop coming up. How does the framework from Ben Graham, a value investing portfolio, how does that fit in with retirement years? I think today, with rates being as low as they are, it's imperative. That's really an important thing to do, to be aware of, that you're probably going to have to do things a little bit differently than the average person is doing them if you'd like to retire, take out 4 to 5%. We're going to come back to that rule in a second. The how much can you safely take out of your portfolio over time? Yeah, so in fact, I'm coming up here a few minutes later on a commercial break, the second part of today's show, we will talk specifically about how much money to take out of your portfolio, what you should be doing to review that process on an ongoing basis. It's really once a year. You should probably take a look at what you're taking out, how you're taking out. I'm going to give you some guidelines. We'll talk about that again at that workshop. And again, that workshop is March 16th, Thursday night, 7 o'clock. It's going to start at 7 o'clock. I will be there a little bit early to talk about the individual stocks. We've got another website we're still working on. And boy, the legal part of this stuff is really complicated. So I would have hoped to have had this out by now, but we're being held up by a few things. So anyway, that is coming though. That is the other side of investing, the side that Ben Graham really didn't like a whole lot, and he called it speculation. And I had some really negative things to say about that. That's okay. Everybody is entitled to their opinions. And I'm actually kind of agnostic. That means that I don't really, most people like to paint themselves into a corner saying, I'm only doing this. This is it. This is how everybody should do it. I don't believe that. I believe you do what's best for you. And it may be trend following trading. It may be deep value oriented investing. Or anything in between. And you just have to figure out what works best for you and what you think you'll be most successful with. That's not an easy thing to do, incidentally. So that's why we have these seminars on an ongoing basis. That's why I have lots of conversations with clients, particularly in the first 3 to 4 years. We have a ton of conversations about it. Generally, it starts to slow down a little bit. You should probably review your stuff at least once a year. At least once a year, 5, 10, 15 minutes. What are we doing? Why are we doing it? How are we doing it? What do you think? The landscape does change over time. It doesn't change dramatically from year to year, but there are minor changes that you should try to keep up with that. That's fairly difficult to do, in fact, because I do it all the time, and just noticing those things, noticing what changes there are. I'll tell you, over the past 10 years, the changes have been more and more computers running more mutual funds instead of people. It's because exchange-traded funds are basically mathematical formulas that they use to run a particular model. Indexing has had an enormous impact on the financial services industry. So many people have given up the ghost, so to speak, and are acquiescing and bringing out more indexing-type funds because they've done better than a lot of other funds. But here's the thing: if you're going to do an index, and you're going to take that risk, the same risk that we just talked about earlier in the show about somebody retiring in March of 2000 and having to go back to work 16 years later because they've spent too much money and weren't able to generate a whole lot of return by using that traditional model. And you know what? The people that are selling those index funds are big. Like Vanguard. Vanguard's huge, and they're actually the largest now. And the vast majority of their funds are index funds. They don't talk about the risks of indexing or what happens when a strategy becomes too popular. They're never going to talk about that because people would pull money out of their funds, and that's how they earn their living. So they're not going to talk about that. We'll talk about what you can do about that when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back at a couple minutes. And we're back. So, hey, if you have a phone call, question, or comment, 216-901-0945. That's the number here at the station, 216-901-0945. And feel free to give us a call and talk about anything investment related that you'd like, personal investing, investment planning. One of the areas that I think gets a lot of, actually, let me make that statement just the opposite of that. My mind is freezing up on me this morning. It's the opposite of the information or the attention that it should be getting. It's getting very little attention. People talk about so many other things to distract. From the number one thing that should be on most people's minds is, how am I going to invest to be able to retire one day? That should be the forefront of most people's thoughts. But you've got an awful lot of people who are concentrating on things that are not that important. Investment planning, one of the most important things that you can do. And it's kind of just glossed over. It's glossed over because people will distract you with things like, estate taxes, or let's get your estate in order, or you need to buy this insurance for long-term care. That's important, but it is important. But one of the most important things is, let's make sure you have money to protect in buying that insurance policy. That's really important. And I've got a quick phone call I have to take here. And Nancy, you're on the Bullington Capital Report.
Hi, how are you?
Good, how are you?
I'm looking for, I'm searching for second and third opinions.
Sure, no problem.
Anyway, I heard that as of April 10th, the banks will no longer help anybody with their investment brokers if they have less than $50,000, and if you're an established customer. Otherwise, you got to go on the phone, and then if you're a new customer, you have to have $100,000 before they'll give you a personal interview with one of their investment brokers that services the banks.
Right.
Now, one person said that was the banks that came up with that, and another person says that there was an 1,100-page regulation passed through the Labor Department that forced the banks to do this. Do you know which it is?
Yeah, no, that's not true. Actually, that's the bank's own personal decision, and I think they're all making mistakes. But that's my opinion.
So there's nothing that in the regulations passed last year through the Labor Department that would cause them to make this decision and get rid of the small investors.
No.
And just latch on to people over a certain amount.
Right. Absolutely not. And it's a decision by the banks themselves, and they've all had them. They've all got them. In fact, your bigger brokerage firms, if you've got less than $100,000, you have to go through a call center.
Right. That's what they say.
Right.
You have to go through a call center.
Right. And that is not the case with Bullington Capital, I can tell you that. I actually gauge whether or not I'm going to get along with, depending on what type of personality you have.
Oh,
so
okay.
you can start off relatively small with us, and it doesn't matter to me. I make enough money. I don't have a lavish lifestyle. So I really like to surround myself with people that I really like. And that's what's more important. In fact, I will tell you that maybe 1 out of 4 out of or 5 people that come in to set up an appointment actually end up opening an account with us because I tell them things they don't want to hear. And I'm telling them, I don't care what they want to hear. I'm telling them how it is.
Yeah, you got to tell them the truth.
Absolutely. Because you know what? They're going to find out. They're going to find out. And it's tough. When you tell somebody that the average stock of the New York Stock Exchange back in 1990, the average range for the average stock in 1990 was 50% per year per stock. That was the average across the New York Stock Exchange. Do you think stocks are less volatile today than they were in 1990?
Wow, I don't know.
They're not.
Okay.
So that average is it's around 50% a year. You can have a great company and its stock can drop like a rock.
Oh, I listen to the stock, the investment reports to see how different companies are doing. And
Sure.
Trust me, all somebody has to say is one wrong word and that company's stock can tank.
Yep. And it's all based on perception. It's not based on what's actually happening at the company in many cases. I would say in a majority of the cases, it's based on the perception. And that's where guys like Ben Graham, it's why I built a model using a lot of this stuff that he talked about years and years ago. That really hasn't changed all that much. You'll see companies that just get kiboshed because somebody said something was going to go wrong, and all of a sudden you've got this big herd of people, actually professional investment advisors, incidentally, and portfolio managers selling the stock. It'll drive it down way below where a reasonable buyer would want to buy it. And that's the trick, is figuring out what a reasonable buyer would pay for something and then trying to buy them for less than that. That's the whole value approach to investing. We want to buy stuff that's selling below what a reasonable investor would normally pay for a company. And it's a lot easier today. So something that you brought up, I deal with this firm called Folio Institutional. And the way that it's set up there, I can run a particular model or folio, and I can have multiple models in my account. I can have as little as $1,000 in one of those models. and it can go up to 100 stocks. They will buy fractional shares, just like an exchange-traded fund does every day. But you can do this yourself. It's like having your own little mutual fund all to yourself.
Oh, wow.
Yeah, it is cool. It is. I've been using it now for about going on 6 years, and it's amazing. Other firms, these guys are the first ones out to do this. No one else has the technology yet. Eventually, they will. I don't know when that's going to be, but eventually they'll all be able to do this, and it is really, really a neat thing. And with Folio, what they've done for me, and which I really appreciate, they typically had a $300 a year would be the minimum fees. They don't charge commission; they charge a fee. You could trade all you wanted. That you can't go above their $300. Well, for my firm, Bullington Capital, they've dropped that down to $50 for any one of my clients.
Mm-hmm.
So I could do that for somebody if they're a nice person and I like them, and they don't run out of my office because I told them the way things were instead of what they wanted to hear. Then they could have as little as $5,000 and still have the same services, still invest the same way I'm investing in my own account.
Yeah, because, to me, I think this is a bad decision because I remember, before all the gas stations took over being a convenience store, too, right. There used to be this little convenience store in the neighborhood because there was nothing, no grocery stores or anything. This was like 20 years ago. And just a little hole in the wall, but it had all the little milk, chips, pop.
Right. Yeah.
The little daily things that you like to get you run out of. I heard that they were doing $800,000 a year. I said, "Are you kidding me?" And he says, "Nope." But then, of course, now all of these gas stations took over the convenient business, and I know that one girl worked at one of the major gas stations with the convenience, and she says they pulled down $40,000 a day.
Wow!
In sales.
Yeah,
that's one gas station.
Yeah, location of those stations actually matters a lot. But but I hear what you're saying, and that's true. There are lots of gas stations like that across the country, and it's the same sort of idea. But I understand what the big firms are doing. Their margins are not. They don't make enough money off of a small account, and they have the same risk on a small account as they do on a large account many times.
Right.
And also, they'll have typically a lot of smaller accounts are held by people who aren't very sophisticated, and will actually be a lot more work. So they're doing a lot of work and not getting compensated for it. So they've just decided that they're just going to push all that to a call center somewhere. Same thing with robo-brokers. You've got these companies that set up, they're doing all their work on the phone. Mm-hmm. They've just cut their margins down big time.
That's so impersonal. And, if you got if you ever tried calling these companies to get answers to questions, doesn't matter who the company is, whether you're calling a repair shop for service or all these cable companies, just to have to go through 5 minutes of we'll connect you to this one, and then you could wait 15, 20 minutes, and they got to ask permission. That's so impersonal. And when somebody's dealing with your money, hey, I want to talk to you up front, close and personal.
Yeah, and I think they're missing that point.
I think because one company I know of years ago, they set a limit to the little shops that bought from them. They were a major supplier, and they raised the limit to $5,000. And so a lot of little shops didn't buy that much. They bought maybe 1,000, 2,000. And so after about 5 years, they started sending the salesman back to say, no, we don't have a limit anymore. So I guess those little shops added up.
Yeah. Yeah, somebody figures out how to do that. It's funny. The businesses kind of go cyclical like that. You'll have them looking. Everybody wants to get the big order, super profitable customers, and just have a few of them and not have to do a whole lot of work.
Right.
And then somebody will figure out how to service those other smaller accounts, and they'll go back to taking on lots of small accounts, and because they figured out how to make them profitable. And that had a tendency to happen throughout a lot of different industries over the years, especially in the service industries. And so eventually they'll figure it out. And in fact, what I think is going to happen in my business is you will talk to whatever device you have in your house. Like I think Amazon has Alexa. Google's got the Google thing where you actually speak to it. It can hear you. A little creepy, actually.
Oh, wow.
But you speak to it. You can tell it to ask it what the weather's going to be. You can ask it all kinds of questions. You can have it turn the lights on. You can have it control your house if you want. So I think what's going to happen is you'll say, hey, get a hold of Bill Bullington, and I want to talk to him. So I'll pop up on your computer screen if I'm not talking to somebody else. And what are we going to do today? Well, here are the various strategies that we have, and these are the ones that I like personally. What do you think? You'll say, I like that A, B, and C, and make that happen for me. Okay, it's already done. But when you say that, the computer's actually going to take all that information and build your portfolio.
Oh, my goodness. Yeah, I don't like that impersonal touch. And just like when I used to do bartending, they said the little average bar says, our business is the person that comes in every day and buys that one or two drinks, not the weekend warriors.
Right.
That's what keeps our business cash flow good. So that's what's going to happen to the banks because, like I said, having 10 people with 10 people with $10,000 rather than one person with 100.
Well, and I'll tell you where I think I see a big advantage. Now that you brought that up, the smaller banks have access to a lot of the same software programs through the cloud, through the internet, that the big banks do, but they don't have hundreds of millions of customers.
Right.
Or millions, I shouldn't say hundreds of millions. There's only 300 million people in the United States, but they don't have nearly the customer base, but they have access to provide the same sorts of services and resources now because they're available online through the internet. And software as a service, they can actually cater much more and give a lot of that personal attention. The smaller banks definitely have an advantage over a lot of the larger banks because of the speed with which they can move. If they recognize it, that's the trick. A lot of the smaller banks don't understand. A lot of them are throwing their hands up in the air and selling out. They're selling their banks to the bigger banks. I'm like, no. You don't want to do that.
Oh, this keeps them big guys in line when you got a lot of little competitors underneath.
Yep, absolutely. So
well, it'll be interesting to see how long this will go because, these people with the big bucks, they're not always, they're a lot of times they're penny wise and pound foolish with their money, too.
Yeah, I know. That's the tough thing about investing in stocks.
I listened to enough of that American greed
yeah.
and those scams that poor people lose their money, but,
right.
What people do to, one person can scam that many people.
Yeah, it's amazing. It's amazing.
So, all right. Hey, thank you so much for
thanks for calling. Sure.
Bye.
Have a good day. And feel free to call 216-901-0945, 216-901-0945. Feel free to go to my website, bullingtoncapital.com, to sign up for that seminar coming up. A lot of this stuff is common sense. I think if you're a accountant or CPA, you might be really interested in what I'm going to be talking about there because, it's stuff that Ben Graham wrote about back in 1949. This is a more modern version of that. I'm pretty sure he would like what I'm talking about because I'm taking the amount of operating income. So if you're an accountant, you know what the operating income is. And for those of you that don't know, operating income is a form of cash that the business is generating. It's before they take depreciation. I'm sorry. It's including depreciation and amortization. If that doesn't mean anything to you, don't worry about it. Basically, operating income is before you pay taxes or interest on the debt, how much cash did you generate? Okay, before you pay interest or you pay the taxes on it, how much cash did you actually generate? That's a good kind of a 60,000-foot view of what operating income might be. And that's what somebody that like Warren Buffett would look at, or a private equity firm would look at. One of the things that they want to see before they buy a business is that they can pay their bills and they have something left over before they have to pay interest or taxes. Great idea. If you're looking at a business, aren't you really interested in how much money you'll get back if you buy that business? Absolutely. We'll talk more about this after these commercial messages. Listen to Bill Bullington right here on 1420 The Answer. Don't go away. I'll be right back.
I work all night, I work all day to pay the bills I have.
And we're back. Hey, by the way, if you've got a phone call, question, or comment, you can not only call in today's program, 216-901-0945, you can reach out to me at bill@bullingtoncapital.com or go to my website. There's a contact us form. It's bullingtoncapital.com. Drop me a line. Drop me an email. Be glad to try to calculate that. In fact, I got a question that was from somebody who was trying to calculate what their returns were and was having questions on that. So the easiest way to calculate returns is to take a look at the beginning balance, then take a look at the ending balance. Okay, and you can get a calculator out there that'll tell you if you don't know how to do that. Take the ending balance, subtract the beginning balance from it. That'll give you a number. Divide that number by the beginning balance, and it'll give you a percentage. There you go. So, in fact, the math, I forget a lot that most people don't have to deal in percentages, and the vast majority of people are not very good at that. And, you're talking about math that's taught in the 5th grade, but if you don't use it, you kind of have a tendency to lose it. So I understand that, but calculating what your returns are is relatively easy to do. Now, if you want to get really fancy, like I had a guy that was calling up and said, hey, Fidelity, because Fidelity doesn't do performance reporting at all. The firm folio I use, they do. So I just take the statements out, find out what they've invested over which time periods, and pop it in a calculator, and it'll calculate the returns for you. And I tend to have to go more conservative. I use a monthly compounding, which will have an impact of making my returns, the ones that I calculate, look a little bit lower than the way that a lot of other people calculate those returns. I do that on purpose because I've been around for a very long time, and occasionally I'll get somebody who's a banker or a CPA who's really sharp in investments, and they'll want to see it the way that I do it. So I just started doing that way for everybody. If you ask me what returns are, I'm just going to get my calculator. And by the way, these calculations don't take that long to do, especially if you have a compound interest calculator. So doing it, yeah, it's a pain. In fact, I've been procrastinating going back and learning about a bunch of really more complicated situations. Like, let's say somebody's averaging or putting irregular payments into an account. Now, that is a bear, by the way. I used to do it a lot more than I do now, and you have to do that one all the time to be really conversant with it and good at doing that sort of thing. But anyway, make a long story short, one of the simplest ways to figure out how you did is where did you start with, where are you now, and get a compound interest calculator and put those two numbers in there, put the time period, and then solve for the investment return. Not all that difficult. So, again, if you have any questions like that, feel free to email them. I'd be glad to talk to you about it. But pretty interesting. We've got this seminar coming up. We're talking about some of the things that Warren Buffett does today. We're talking about some of the things that his first employer and his graduate school teacher, Ben Graham, the guy that wrote the book Intelligent Investor. This guy was way ahead of his time, and he's really kind of considered by most to be the father of modern value investing, which is not that easy, by the way. Psychologically, it's not easy. I'd say intellectually, it's not that hard. Not that hard to understand. And we built a model along these lines, and I have to tell you, the reason I built the model was, and I've got a dividend model that I really like a lot. You can see the outline or hear about the outline on the model on my website. There's a little video section in there, and it's the high dividend model. I like that model a lot. It's had really good performance the past few years. The concept also is Ben Graham-esque. It's actually a little more aggressive, and it's an aggressive value model. So, but I really like it. And the vast majority of people that have invested in it, they like it too. I have a momentum model, which he probably would not have liked. I know he wouldn't have liked it too much, but that's okay. There's more than one way to do this. There are lots of ways. And again, I told you earlier in today's program, I'm a little agnostic. I really don't mind using anything that has common sense to it and has worked. If it works over time, then I'm pretty happy to use it. None of these work like most people would like them to work, but if it makes money, if it keeps me in the top 25% of my categories of my peers, people that are doing the same things I'm doing, then I'm going to use it. So if I didn't like it, and there are some strategies I just don't like, so I just refuse to use them. They're, in fact, one of the reasons I refuse to use them is because I've never seen anybody actually end up staying in the top 25% of their categories by using some of those strategies. So that's really what kind of makes the deciding factor for me. And it's not like I'm not telling you that I know all of them. I'm telling you I know an awful lot of them, and most of the ones that work actually have a lot of things in common. And those things that they have in common are they're looking at price movement and they're judging that some way, and those are the momentum strategies. The value-oriented strategies, like the dividend model, are looking at things that have value. A dividend has value. It's cash. It's cash that the company's generating that they're paying out to you. I didn't really want to get into talking a lot about that. That's an aggressive one. We'll talk about that next week. I bring it up at every workshop too. But some people were uneasy with some of the stocks in the portfolio, and they didn't care that there were more than 40 stocks in this portfolio. So, which means you have less than 2.5% of that particular portfolio, and that portfolio had never made up more than 30 or 40% of somebody's account. So, from a level of diversification, you are extremely well diversified using that. And they let the idea that there were a couple of stocks in there that they really didn't like that were in their portfolio, even though it was an incredibly small amount and couldn't do a lot of significant damage, they still let that get to them psychologically, and they abandoned. And by the way, last year was one of the best years for that aggressive value strategy. They abandoned it. And man, they really missed a lot. But it was because they were uncomfortable. And that's one of the things that you kind of have to do is find some strategies that you think that you can be comfortable with, or at least find those strategies that you can tolerate. You may never be comfortable, but at least if you can tolerate them, you can have a good chance of being successful. And here's why. Dalbar does a study every year. They update it about the average investor's returns. The average investor doesn't come anywhere close to doing what a market cap, what most index funds do. The average investor comes nowhere close to that. Why? And I'm here to tell you it's because they're uncomfortable with what they're doing to begin with. They don't really understand it. And when they start seeing the stocks fluctuate, in other words, going down, which is part of the fluctuating process, they panic. They get upset and they leave. So they leave the markets or they change investment advisors. Somebody else, by the way, they're going to get the same thing with a new investment advisor. They got the old one, but a smart salesman, a broker who's not an investment advisor will tell them whatever they want to hear, get the money, get the commission, and then, they're going to find out that what they got was similar to what they left, because you hate to go from bad to worse. That would be bad. The bottom line is you've got to be at least tolerant of the investment strategies. And everybody goes through that process. It doesn't work like you'd want it to work. The way that it works is very different than that. That's what the whole book, one of the main ideas of the book, The Intelligent Investor, was about. How does the market really work? What do you do? He coined the phrase margin of safety. How do you put a margin of safety? Well, one of them is by diversifying. And he talked about that. And he held over 100 securities in his portfolio, 100 different securities. Okay. So diversifying is one of the things. Everybody's heard about that. But the other thing was a margin of safety. What's the margin of safety? Well, you're looking at a business. No business is completely safe. They're all stocks. They're publicly traded companies. They have the risks. They have employees. They have suppliers. They have big customers that may decide to go somewhere else. So they all have risks. Okay, but you want to minimize the amount of risk that can have on your portfolio. And quite frankly, my momentum model, my high dividend models are the more aggressive side. I've got two that are slightly less aggressive. They're still in stocks, but they're slightly less aggressive. And I think intellectually, it's a lot easier to stick with something if you really like the general idea of what it's doing. I'm going to explain. Don't panic. And also, if you want to see this in great detail, sign up for that workshop, March 16th. It's free. There's no cost to attend. Corporate College does a great job preparing for that. We have refreshments there. They do a phenomenal job there. They actually have 4 or 5-star restaurant right in the building now, which is kind of new since the new management took over. So it's a good time, and it costs you nothing. And you can come in and see these things in greater detail than I'm able to show you or talk to you about on the radio. So the bottom line with this is I'm taking the cash that the business is generating, dividing it by the total cost of the business. If someone were to buy that business, it gives you a yield. So now I can compare companies to one another, and I can compare it to CDs or bonds. How cool is that? It's so simple, but pretty profound in the same text. And I've just been told I only have 30 seconds left before the music starts. So I'm going to have to say goodbye. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.